Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.
All right, today we're going to do something a little different, and we recently put out a episode on excess returns where we took answers from almost, well, I guess it was 70 different guests that have appeared on our podcast, and we always ask them a standard closing question, which is, if you could teach one lesson to your average investor, what would that be? And that podcast, that episode is full of knowledge and wisdom and great responses, and the responses are really ultra wide ranging. So what we wanted to do today is we each went through and picked, and they're all great, but we went through and picked sort of the ones that stood out to us the most from those 70 responses. And so I have three that we're going to start with, and then Matt will go into his and Jack will go into his. But to start, for me, it was the Larry Swedroe interview, and his basic answer was on that question was about taking a long-term view.
I've already mentioned, which is don't confuse information with knowledge. That I find is one of the worst mistakes. But the other would be this, since we covered that one. It is my experience. Well, let me say it this way. Any good financial economist knows that all risk assets, any strategy involving investing in a risky asset, will go through very long periods of poor performance. For example, there are 3 periods of at least 13 years with the S&P 500 underperformed totally riskless treasury bill. From 29 to 43, that's 15 years, 66 to 82, 17 years, and 2000 to 12, that's 13 years. That's almost half of the last 93 years of data that we have. And yet, if you held on, you got 10% a year. But if you panicked and sold, you did. And that's a problem. Now, maybe people hold on when they think about stocks, but we know many people panic and sell. But if you don't panic and sell during that period because you're smarter than that, you've built a plan to withstand it, why do you panic and sell when value does underperform for 4 years? Or reinsurance has 3 bad years from 17 to 20. Or AQR style premium had a horrible period for 3 years or so because we had a 5 standard deviation event where value had a bigger, growth had a bigger bubble than it did in the 90s. People panic and sell because they think 3 years is a long time when it comes to judging performance. 5 years is a very long time, and 10 years in an eternity. That literally is nonsense. And what that tells you is, since any risk asset can and will go through long periods of underperformance. Here's one other. Gold. From 1980 to 2002, this supposed inflation hedge underperformed inflation by 86% over 23 years. Every risk asset you can think of goes through such periods. So what should you do about that? There's only one logical thing you should do. Since you can't predict which will do well when, all the evidence says active management fails at doing that. You want to diversify, of course, as many unique sources of risk as you can identify that meet the criteria Andy Birkin and I put in our book, Your Complete Guide to Factor-Based Investing, meaning that it has a premium, It's persistent across economic regimes, long periods of time. It's pervasive around the globe across asset classes. It's robust to various definitions. So value works, whether you use PE or EBITDA or cash flow. Momentum works, whatever the formation and holding periods are. It's implementable, meaning it survives transactions costs, and there are logical risk or behavioral reasons why you think the premium should persist. If it meets those criteria, then you should diversify across them so you don't run the risk of all your eggs being in, say, a beta basket. And here's the final example to make that point. 40 years, 69 through 08, both large cap and small cap growth stocks underperformed the 20-year treasury bond, which is the totally riskless asset for a long-term pension plan with nominal liabilities. That's 40 years where growth stocks outperform, and you abandon it, and then you miss out on the great returns you got after. So why would you abandon value when it underperformed for 4 years? Or reinsurance when 3, or a long-short value, long-short factor strategy underperformed? That's why we diversify, rebalance, and stay the course. That's the lesson.
And so I think, Larry is full of knowledge and wisdom, and he's an evidence-based investor. And he really emphasizes, and this is very important, that there's periods of time where the stock market may not produce outperformance. I mean, over most 10-year rolling periods, you're probably going to make money in stocks, but that's not a guarantee. And I think to me, what stood out at least was the definition of a factor, what makes a premium in the market, i.e. value stocks, or maybe using momentum, or these different factors that have been proven over time. And that, if you have to maintain the utmost discipline when you're investing in these factors. It's like, you might think a 10-year period is long-term, and for the vast majority of investors it is. But if you're investing in these factors, trying to get a premium from them, you have to make it through those periods when they don't perform, because that is how you'll be rewarded ultimately in periods that they do finally deliver that type of premium in the market. So Jack and Matt, I don't know if you guys have anything to add to that, but that's what stood out to me in Larry's comments.
Yeah, what kind of struck me about this is I think people treat premiums a little bit differently. So, we talk about the value premium, and we talk about how value has these long periods of underperformance, and people are like, oh, that's really terrible. But then, people don't realize, like, investing in stocks is a premium. Like the equity risk premium, the return over the risk-free rate, that also has these long periods. Larry talked about that in there. I think he talked about, like, there was a 13-year period. There's a bunch of these decade-long periods where there is no equity risk premium. So what I took from it is no matter which premium you're investing in, you have to understand there's going to be these long periods where it's not going to work. And, sometimes separating like factors from the other part of it is not what you want to do. Like you want to look at them all that way. Like if you're investing in any of this stuff, you're going to need patience.
An equity risk premium doesn't mean like no return, right? That's the other thing. It's not like 13 years has to be a negative return. It's just there was no equity risk premium. So stocks might still be up. They just weren't as much as the total return on the bond portfolio. And inflation muddles all this stuff up too. So I love the way you just framed that. The other thing that we talk about all the time at Sunpoint is the behavioral investor types. And that's this idea that if you're going to go after a factor premium or some type of alternative to just market beta or bond beta or whatever, that has to align with who you are behaviorally. Like Buffett as the traditional value guy is like, well, yeah, obviously this guy will live and die with the underperformance and be totally cool with it every day of the week, every month, every underperforming decade. And you should, if you're going to seek to be somebody who's using a multi-factor approach or a factor approach, like understand how that goes with how you're wired. Otherwise, you're going to abandon it at just the wrong time.
The next one for me was the episode we did with Matt Bartolini of State Street.
I would say be part goldfish and part elephant. So goldfish have an incredibly short memory. Elephants have an incredibly long memory. Researchers have shown that elephants can actually recognize enemies and friends over a long time frame. So when the market falls by 4% on a single day, be like a goldfish, kind of look past it and just forget it, because typically what we found, and again, the stat could be off by 1 or 2 days, but when the market has its 10 worst days, it's typically followed by its 10 best days. Then sort of be like an elephant. Understand that over a long time frame, there's certain premiums in the market that's been rewarded. Diversification has a long history of being beneficial to overall portfolios. So definitely take that long view, have that long memory of what has historically worked. So I always sort of think about it, be part goldfish, be part elephant.
I love that. That's awesome.
Yeah, we actually tell our kids on the baseball team to be like goldfish when they strike out. So
There you go. He sort of opened the response up with be part goldfish and be part elephant. I didn't know where he was going with this, but it was kind of insightful. So he was basically saying that goldfish have very short memories and elephants have very long memories. And as an investor, what you want to do is you want to be a goldfish for short-term market like noise. Like you want to just forget that. Like this happened today, this is going to happen tomorrow, you don't want to basically be making investment decisions based on the short run, but you want to be like an elephant in terms of thinking long-term and remembering things that are important in returns, like diversification, like having exposure to various asset classes, dollar cost averaging, the things that we know are being disciplined, the things that we know that are important drivers of long-term investment success. So I just thought that was an interesting, I don't know, maybe it's not necessarily a parable, but it kind of got me thinking too. There's the, have you guys heard of the goldfish parable? Have you heard this? The two goldfish that are swimming? Okay. So it kind of relates to this. So there's these two young goldfish. They're swimming along, enjoying their day, and they swim by an older goldfish who nods his head and says, "How's the water, boys?" And the young goldfish continues to swim along, and then the other one turns to the other and says, "What the hell is water?"
That gets at what I think was potentially one of the best speeches of all time, which is that David Foster Wallace speech. This is water. Like that was incredible. Yeah, like that's a really, like anybody who hasn't watched that speech, I would highly recommend you watch it. It was amazing.
I have to say too, so obviously shout outs to Ted Lasso season 1 and the Be a Goldfish speech, which I imagine you guys are both familiar with. Are you Ted Lasso fans?
I've watched just a few episodes actually. It's kind of embarrassing, but I've only watched it a few times.
It's all good. There's a beautiful Be a Goldfish speech in the first season. That's just magic. Just Google it. It's totally worth it. And give some shouts to the elephants too. So I was thinking because I love this comment and I love this idea. I was like, okay, my top 3 elephants are Dumbo, because sometimes life gives you really crappy things and elephants can fly and that's just the life stuff. Number 2, definitely Jason Isbell's Elephant, which, do you guys know that song?
I don't know that song.
So that's about sometimes life gives you something crappy, but there's nothing you can do about it. So it's about a friend who has cancer and basically trying to spend time with this friend who has cancer to enjoy life despite try to ignore the elephant somehow is like the chorus. And it's devastating, but it's like sometimes there's stuff that just sucks and you have to figure out how to live life around it. And then third elephant, I think of this as the Seth Godin elephant, but are you familiar with the idea of giving the gift of the white elephant? Have you ever heard this? Another like parable? Do you know this story?
But go ahead.
Okay, so if I give the gift of a white elephant, on one hand, the white elephant in history and culture was this great sign of prestige and whatever else, and it's a wonderful thing. The reality of the gift of the white elephant, though, is I now have this thing that's expensive to maintain. It's kind of a pain in the butt. White elephants, you couldn't traditionally put out to work in the fields, so it's actually a burden. And so the reason I would put this as the top 3, or my third elephant, is sometimes you get stuff that you can give back. You can't give cancer back. You can't give the Dumbo scenario back. But sometimes something that's really great, you just have to say no to. And this whole goldfish elephant thing, I love the idea of there's different elephants in the room. There's different elephants in our lives. Some of them we have to accept. Some of them we just have to go, what actually matters here?
Well, first of all, Matt, we should have known a top 3 list was coming here at some point in this thing. I didn't know if you could slip it in, but top 3 elephants is very impressive. But second of all, for me on this lesson, I think it really comes down to it's very important to understand what you need to remember and what you need to forget. And so you need to remember a lot of things that work over the long term, you need to forget the last Fed meeting. You need to forget like 3-year returns, 1-year returns, 1-month returns, like, whatever, the GameStop thing. I mean, it's really important as an investor to kind of have those 2 buckets. And like, these are the things I really need to remember, like, to be successful. And these are the things I need to forget. And like, none of us do a very good job of that. Like, like those of us that are professionals still struggle with this. Like, we're remembering things and worrying about things and, what's going on with the economy today and all that stuff. But, the more you can take that stuff out and recognize what's really important, I think that's really important to do.
Future episode, things we hold long-standing irrational grudges against in markets.
And the last one for me is the interview we did with Ben Inker from GMO. And he was making the point of, as investors, we need to understand who is on the other side of the trade or investment that we're making and why do they want to give you that return.
I wish it was a really simple thing. I think it's a simple idea, but it requires more work than I would love. But that is, whenever you're investing in something, make sure you understand why you should get paid for owning this asset, for performing this activity. Understand why it not only makes sense for you as the investor, but whoever is going to be funding that investment on the other side. Why it makes sense for them to be giving you the return you need. I would say there's a lot of errors people can make as investors. But one of the crucial ones that people make time and time again is forgetting about the fact that if you're going to sustainably get a return, it needs to make sense to give you that return in terms of the person on the other side. And where you can't answer that question well, you're not investing, you're speculating. So I would say, for the retail investors who are buying 1-week call options on AMC, the reality is you're not investing. The person on the other side has no reason to want to give you a high return, right? The person on the other side, for one thing, is a market maker, and the market maker is the casino. The casino is only there to try to make money off of your activity. But the simple truth is, whenever you're buying a call option, you're not doing anything useful. You only get the upside. And if you only get the upside, the person on the other side only gets the downside. There's no reason for them to want to give you a good return in the long run. So I think investors could avoid a lot of errors if they thought not just about, does this make sense for me? But does this make sense for me and the guy on the other side? If it doesn't make sense for the guy on the other side, this is not going to be a sustainable strategy in the long run.
So that's very important, as we think about when we're investing, whether we're investing in stocks or bonds or something else, who's on the other side of that and where is the return actually being generated from? And kind of his bigger point was, if you don't understand that, then what you're really doing is you're not really investing, you're really speculating. And it's hard for investors. Not all investors are going to spend the time, be interested, or understand it. But I think for the people listening to this podcast that have followed us for a period of time, I think that these are inquisitive investors that are interested in knowing where the return is coming from. And so I don't know. I thought Ben's point was just a very good one.
To me, this is like, you have to learn to separate what did work from what will continue to work. And so, like, if for the example of GameStop call options, like we can all run in the trap of, we do something like that, it works, and we think we're like the smartest investor in the world because we figured that out. But then you have to take a step back and say, all right, who's on the other side of me buying GameStop call options? Well, it's Citadel. Like, those are the smartest people in the world, and they Ken Griffin is rich for a reason. Like, the odds of me continuing to do something like that and have it continue to work are very low. But that's one of the hardest things to do as an investor is, I don't know if you see this with clients sometimes, Matt, but like when something works, separating from, was I actually good or, was I just lucky? That can be really hard to do. And sometimes when you have success early, it's like the ultimate bad thing as an investor because you think, I'm going to keep doing that thing. And sometimes that thing ends up destroying you.
It's all about, and I know I'm not trying to plug my comment on this too, but it's markets and marketing. There's a story, and that's what is at the heart of, I think, what Ben is trying to get across here. And it's this idea that like buyers and sellers both have a story that they're selling and they both believe it. The seller needs to sell for some very compelling reason and the buyer wants to buy for some very compelling reason. And we should never separate we should never like separate those things or ignore that they don't exist, because that's how we always get into trouble. And if your research doesn't include saying, why would somebody be selling this to me now? Why should I be selling this now? Who's my buyer? If your research doesn't include that level, you're definitely going to get a rude awakening at some point. So I think it's my turn now. So the first one that I picked was Michael Mauboussin. And God, when I think about people who have had an outsized impact on my own life and philosophy when it comes to stuff like this, he's on the Mount Rushmore. So I picked his comment about base rates.
I think that I would encourage people to learn about and apply base rates as they think about the world of investing. And by the way, it's not just valuable for investing, but really business or your life. Actually, it's good for your life. And again, a base rate, the basic setup is the natural way to think about the world or solve your problems is to gather a bunch of information and combine it with your own inputs and experience and project into the future. And that's what we all do left to our own devices. Using base rate says, I'm going to think about what I'm facing now or my problem as an instance of a larger reference class. I'm going to basically ask what happened when other people or organizations were in this position before. And it's a very unnatural way to think because you have to leave aside, sort of your own information gathering and your own experience. We all tend to place a lot of value on that. And you have to find and appeal to the base rate, which may not be at your fingertips, and often it's not. So you have to go out and make a little effort to find it. But once you do, I think it reshapes how you think a lot about the world. And I think makes you more grounded in terms of how you think about how things are likely to unfold. So to me, if that would be the one idea, is to say, let's think about base rates. You mentioned before jokingly that we're in that sort of season where people do forecasts. That's a great example where base rates would be very helpful. And you sort of made the joke 10% with some standard deviation, but that's actually the right way to think about it. That's actually the right answer. And that's informed by base rates. So you got to the right place and the right way to think about it using that actual technique. So to me, that would be the one bit of advice I would give. And if I could go back to my 20-year-old self, that's certainly what I would teach. And by the way, I would just say that it's remarkable how underutilized this concept is, notwithstanding its demonstrable power, right? So anyway, that would be my concluding thought.
What I love about Maubussin's base rates, just way of thinking, and if you haven't seen his book of base rates from a few years ago that he published, I forget which firm he was a part of when they released this, you got to know what average looks like. And I always go back to this idea that I think is from Scott Galloway, which is things are never as good or as bad as they seem. So whatever's going on in the moment, like there's still some average that we're probably mean reverting to or that we can be aware of. And Maubussin's base rates are everything from like profitability towards like, where do these trends actually go? How big can these companies get? How small is this idea and how essential or whatever should it be? And the idea of a base rate is look at a broader reference set of data, figure out where you are relative to the average of that, and then plan accordingly around it. When I see some of these like startup ideas and they're like, oh, we're going to grow to the moon. It's like, no, you picked an industry that's inherently capped in its size. Understand that. When people have financial plans and other stuff and they set out on these templates, base rates are how we temper our understanding of everything that's happening. And when you know what normal looks like, then you know what not normal looks like. And that's one of the most obvious but helpful things that I think I could imagine for anyone who does planning or investing.
I think with base rates, the big challenge is, Mauboussin talks about the inside view versus the outside view. And, the inside view is what we're all like, that's like our natural inclination. It's like, let's look at the facts here and like, let me do my own analysis and let me figure out what's going to happen. But that usually doesn't work. He's right. Like the outside view, which is the other way, saying like, let's look at what happened historically when these facts were present historically. Let's see what happened. That's a better way to do it. That's less prone to emotions and biases and stuff. So it doesn't work in all cases, but I think that's better. And then the only second point I'd make on base rates is you have to be really careful about what those of us that are quants call the end, which is you'll see sometimes, like you'll see people on Twitter being like, all right, this is what's going on technically with the market. And, when this has happened historically, the market went down 50%. And then you dig into it and you're like, well, there were two occurrences. And, one was in October of 2008 and one was in, November of 2008. And so it's like, it's very important to look when you're looking at base rates, like make sure there were enough occurrences in the past that you actually can make a conclusion versus, just being like two things and suddenly you're trying to draw a conclusion from that.
The plural of anecdote is not data, right? And so like understanding on that scatter plot, like each point is your anecdote. And then how many pieces are scattered here? And how does this fit into the broader picture? I love how you put that.
So just a couple of things. I was first exposed to base rates from O'Shaughnessy's What Works on Wall Street when he studied, these different simple quantitative strategies over a multi-decade period. One of the things that I always appreciated about what O'Shaughnessy did is he, put in there basically what percentage of time the portfolio either out or underperformed. And so that was my first exposure to base rates. And I sort of wish, like all these talking heads and forecasters on CNBC, I almost wish they assigned a probability to their forecasts. Very few do, some do, but most are making these calls and have conviction in their calls, but they're not really assigning, a probability, which I think would be useful for investors. And then the only other thing I was going to say is we haven't published it yet, but we had a podcast with Gene Munster of he's a tech analyst at Deepwater Asset Management, and the guy's been in the tech industry, been a tech analyst for almost 3 decades at this point. And they had an article on their site where they had like this. It was a framework, and the title of the blog piece was "Cone of Expectations." And basically, it was like a big cone, and you could, for growth companies could be in these different quadrants of like expectations. They could be wildly optimistically successful, sort of successful, like not as successful as expected, and all related to growth. But what I kind of relate there is, they sort of assign probabilities to their growth rate expectations. So those are kind of ways from an investor standpoint that, investors can think about base rates, I think.
Yeah, and to your point, like think if somebody went on like CNBC as a market forecaster and they said, and you made this point in the thing with Mauboussin, like they said, my projection for this year is a 10% return with a 68% chance it'll be within one standard deviation of that. Like no one would ever, like they would be kicked off CNBC immediately, but that actually is the right way to look at like market forecasting. Not to like make these crazy forecasts that, never end up being correct.
And that's why base rates are so important. So the next one that I have is Ben Hunt, and this is about finding alpha in the things that are close to you.
So, yeah, I've thought about this a lot actually since our last talk, because I figured you were going to ask me this. And the one, to boil it all down to one thing, it's to understand that markets are a political utility, and that, there's this old story, traveler comes in this old West town and he sees these guys playing poker, and he sees that the dealer is obviously cheating. And he talks to one of the players later and says, well, what are you doing? The guy's cheating. And the guy says, yeah, I know, but it's the only game in town. Right? The stock market, the public market, it's not the only game in town. That we should be trying to connect our investments with the real, not the casino, not the stories that are told to us. We can play with it, right? And I think you're invested in market. If you're going to be an investor, you're looking just to harvest the political utility nature of markets. You're just trying to harvest the beta. But if you're trying to find alpha, you're trying to make an investment, you want to make money, you find something that's real, that's close to you, and where you're not being told a story. That's the advice I've got. You know what it's actually like? It's like the old Peter Lynch. You remember Peter Lynch, right? Where he always said, what do we do at Magellan? Oh, we really invest in real companies. And I don't know, maybe that was possible for Peter Lynch, back in, 1978. I don't know, maybe that was possible for him. It's not possible today, not in public markets. You want something real, you want to invest in your own company, your own self, invest in something that you can understand. And that doesn't exist in public markets today. I'm not saying get out. You use them for their political utility nature. You harvest the beta. You stick it in a drawer and you forget about it. But you want to be an investor. You want to do research. You want to try to make alpha. It's got to be in something real. It's got to be something close to you. I don't think you can find that in public markets today. That's the one thing I'd try to put across.
It's kind of the subtext of this idea, but Ben says you want to make money, you find something that's real, that's close to you, and where you're not being told a story. And I hear this and I connect it back to base rates because I think about the human capital and the investment capital idea. And if you're going to do better than a base rate, like you have to have a reason why. This is like the running theme of all these in my mind. You have to have a reason why you should do better than the base rate, or something should do better than the base rate, or why you might expect it could do worse than the base rate. And this idea that you can only find alpha, you can only do better than the expected average thing in any scenario, in things that are close to you are, 30 years ago, it might have been some block trading scheme that you did to execute trades and your hedge fund was able to do something special in public markets. That's really hard to do today. You need kind of a weird niche where you can do that. And for most of us, we're not going to find that alpha out in public markets, or at least not the biggest of public markets. Might be able to get a few basis points here and there, but it's really hard to get like a massive differential. So in things that are close to us, it might be on the human capital side. We can have, harder to quantify, you can have alpha in taking care of your kids, taking care of your family. You can have alpha in a career, and figuring out where you want to put that focus, that time, that attention, that love, that passion. Like that's where you can really make a meaningful difference in getting ahead, in finding alpha in the things that are closest to you. That really hits home for me.
Yeah, just a quick story with Ben. Like Ben actually lives this in his life. Like I remember when we had Ben on Show Us Your Portfolio, I sent him a DM and I was like, we want you to come on Show Us Your Portfolio. He's like, I'd love to. The one problem is I don't have one. And I'm like, what? You don't have one? He's like, yeah, I actually have no investments whatsoever in public markets. I invest in my kids and I invest in my business. That's all I invest in. So like, it is like, this is the life Ben is leading. Like he is, we can talk about that from a financial planning perspective. Obviously for a lot of people that probably doesn't work, but like this is what Ben does. I mean, he's investing in the things close to him, and he's living his life that way.
To Ben's point, which I think is amazing. And when he said that, I was like, that's a fall out of your chair moment for somebody like me. In a positive way. I think it's so cool. And I remember Michael Kitces, who is like our go-to guy for all things financial planning. Like he's the place I go first when I'm like, I don't understand this topic. What has Kitces written about it? And when he was getting Nerd's Eye View and XY planning and all that stuff up and running, like he wasn't investing in his retirement accounts. He was like plowing it back into the business. And I was like, this is brilliant to have somebody like say this out loud, that find your alpha and it's close to you.
For me personally, I had always mostly invested in the public markets, but maybe like 6 years ago, a good friend of mine who's a real estate investor purchased commercial property here in West Hartford, Connecticut. And I knew about this deal and I was looking to diversify my investments, but also I trust this individual very much. He's very smart. He had been very successful in real estate investing in other parts of the country. And so, but to me, I needed to see the actual physical, because it was an illiquid investment. I knew this was going to be tied up. I needed to actually see what I was investing in. And this was a local property, local real estate deal. So I could go and see it and know what businesses were in there. And that was important to me. So, and I certainly generated alpha on that investment. It did far better than I would have ever expected it to do. And I think that I got alpha through that investment over what I could have done myself in real estate investing, or even maybe the public market. So when Ben was talking about that, I was trying to think about my personal experience with that investment and, what it achieved for me.
Yeah, so there was one clip I want to throw in here too that kind of ties into the same thing as Ben Hunt, and that was Jason Buck, and he's talking about stop thinking about your savings as investment.
It's tough for me. I hate giving advice because I don't listen to any myself, and I don't really think I have any. But I always like to watch what people do, not what they say. And that's why I was happy to be on here to talk about what we do, because that's how I view the world. The one piece of advice I'd give, or I would think about, is that stop thinking about your savings as investments. That's where I think the industry's lied to all of us, is everybody thinks I'm going to put this money away and I'm going to get rich off of it so then I can retire to a beach somewhere. These are your savings. You need there to be when they need them most and to outpace inflation. As soon as you start thinking about a way to get risk, you're going to take imprudent risks and you're likely going to lose most of them, or they can be underwater for decades. So the only way to get rich is in your business, your job, whatever you want to do, but your savings need to be as robust as possible so they'll be there when you need them most.
For me, this one was like really interesting. First of all, Jason kind of starts by saying like he has no good advice to give, and then like gives some of the best advice we got in the entire episode, which was really funny. But it kind of plays back on the same thing. Like everybody's trying to like generate, get rich or generate alpha like in their investments. And Ben's talking about it in a different way, but Jason's kind of saying like use this as your savings. Like this is the money you need when you need it. You need to be safe with this money. And like you're going to generate, your alpha, and you're going to generate your income, and if you're going to achieve great things in your life, you're going to do it in your own life. You're going to do it in your own business. You're not going to do it by like taking crazy investment strategies and following them.
And that kind of flows down to his overall investment strategy, which is making his portfolio and how he invests as robust as possible, and trying to make it so it can withstand any type of investing environment. So that's kind of what I sort of took away from that, is like, yes, it's like the wealth and stuff like that is going to come from things other than your investments, but your investments have to be, or your investments should be looked at as like savings, and you want them to be as secure as possible, and so that you can use them when you actually need them the most.
I like to think of it as it's like squirrels don't have nut coin, right? Like the reality is a lot of this is for consumption. And if you're saving, maximize your savings rate. Figure out how the squirrel can get as many nuts squirreled away as possible. But then like, don't feel bad about consumption. There should be no shame in this. This is what the purpose is for. And if you want to pass it on, like have a plan, because I hesitate to think that like squirrels are out there setting away nuts for future generations or for future winners. Like it's consumption, and then what's left gets returned.
So the next one is Ryan Krueger, and he talked about the advantages of taking the long cut.
I'm working on this for a book, so you got that scoop first out of me, which is good. And it's I'm trying to tell my kids and young investors, but the cool part is my 90, and we've now got 5 clients over 100, they would probably say the same thing. They're still playing the long game. If you avoid an increasing supply of shortcuts, which are in front of us every day, you're all of a sudden, no matter what you're doing, investing included, with the most easy and tangible to see results, you're already finding yourself on some pretty uncrowded paths if you look for every long cut imaginable, and that's not easy. Instant gratification's a real deal. Deferred gratification isn't very popular. I don't even think it's a term, but if I have the choice and the ability to play the long game, I think what I've realized that I come to appreciate more with every passing day since I left Wall Street and started an RIA is this world of abundance, where capitalism works because of competition, and it's wonderful. It's the most pure, longest lasting system I know of. But to be a happy human being, live in a world of abundance. And it is a small, beautiful world, and how you treat people is a big part of this too. And I know I'm getting a little off the path of an investor-only question, but I think they collide with each other. So playing the long game, not just with your investments. And I think, and I said it earlier, it's easy to say hang in there and play the long game. And by the way, notice I didn't say hang in there. I think anybody should fire their advisor or portfolio manager if they're ever told to hang in there. I think there has to be some sell discipline in life if you're willing to play the long game. You got to stop doing things that are not working and do more things that are working.
I just like this one in general. I think it applies to investing, but it applies to everything. Like we always want to do the short way. We always want to invest in the stocks that go up 100% in a month. In our life, we want to do things the easy way. And I just think like it's important to take a step back sometimes and say like most of the time when you achieve great things in your life, most of the time when you do things you're proud of, like you did it the hard way. You didn't just like get it given to you, or you didn't like make one shortcut and like immediately achieve what you wanted to. So like, I just think that was a good lesson for me in life in general, because it's been a problem of mine. Like I've tended to say like, let's do this the easy way. And, just the fact that we have this podcast is probably an example of that, because, back in the day, there were like 3 people, including my mother, watching Justin and I like talk about investing. And, maybe we could have done the bearish episodes where you like have the look of shock on Justin's face and it's like buried gold in your backyard because the world's coming to an end, or whatever it is people do to get like podcasts watched a lot. But we just talked about stuff that we thought was good for long-term investors. And, we've eventually like built an audience doing that. So to me, like this idea of taking the long cut is like a really important.
There's this fantastic Uncle Tupelo song called The Long Cut that as soon as I saw this in the notes that we were going to talk about this one, I was like, oh man, because it's so perfect. It's a relationship rut song. So it's Jeff Tweedy, or Jay Farrar, whichever one wrote this one, basically saying, we're in this rut and it's an ugly rut. And the only way out of this rut is if you want to take the long cut, we'll get there eventually. And yeah, that's what the hard stuff is for. It's not a shortcut, but you'll get there eventually if you can commit to the thing. Spoiler, I don't know that they succeeded in the song and the relationship, but it's a beautiful song.
Well, and when you think about investing, being a successful investor, right, it's and that can be defined in a lot of different ways, but it's being disciplined over a long period of time, whether you're continue saving, allocating to your investment portfolio. It's like that, whatever you want out of your portfolio and your investments in life in the long run, there's going to be periods when it's difficult. There's going to be periods when your money's not working for you. There's going to be bear markets. There's all those types of periods. But if you can take sort of that long-term view, that's what can get you through, I think, those difficult times. And that's kind of what I take from what Ryan's sort of saying here.
So the next one is Adam Butler, and he talks about the importance of being humble.
Yeah, I mean, it would be diversify, right? It would be humble about what you know and what you can know. And don't be over-reliant on what you observed in the past. The past is one sample draw from an infinite variety of potential sample draws that we might get in the future in terms of combinations of inflation, growth, geopolitical risk, supply-demand dynamics, technological shocks, et cetera. And the future is probably going to look quite a bit different from the past. And so the best way to prepare for the unknown is to diversify. So I think that would be my core message.
So to explain this one, I have to tell a story. So back in a while back, we had Rodrigo Gordillo from Resolve Asset Management, Adam's partner, on our podcast. And they were like, all right, you guys should come on our podcast. And so I was like, when Justin asked me, I'm like, first of all, I love those guys. It's an amazing podcast. But I'm like, everybody that's been on that podcast is 1,000 times smarter than me. I'm like, Justin, we shouldn't go on there. We're going to get killed on there. These guys are really, really intelligent. We can't hold our own. But Justin's like, oh no, we definitely got to do it. We're going on there. So then obviously it becomes a week from there. And Justin's like, something came up. I can't make it. So I'm like, oh crap. So it's me by myself now, live, because this one's live. It's not recorded, on there with them. And so, obviously, I think it went okay. I mean, I obviously wasn't as smart as some of the other guys that did it, but something came up on there that I think gets at Adam's lesson, which is I was talking about how we blend strategies at Validia, and I was talking about how we go back historically and we say all right, if we had combined this value strategy with this growth strategy, how consistent would the returns have been? And we look at all of our different strategies and we do that. And Adam sort of called me on it a little bit, and he was right. That's not the only way we do it, but he was right about it. And the reason is that this idea of the paths of market history, and the idea that, even very long periods of time, if I look at the last 40 years and I say, I want to build my investment strategy around the last 40 years. Well, the path we saw in the last 40 years is only one of the paths we could have seen. And it's a path of declining interest rates and the stock market being up and bonds being up. But we can't build our investment strategy just around those 40 years, because we could, if we're about to have a change here, we could make a huge mistake just assuming that those 40 years are what's going to happen going forward. And so this idea that no matter how long market history you look at, it's just one path of a variety of paths we could have seen, and being humble about the idea that what we see in the future might not be what we see in the past. So I think that's what I took from that one.
Yeah, I think that's very powerful. It's very important for investors to think about. I think I've kind of probably fallen victim to, looking at the past and sort of extrapolating it going forward. But the point, I think, too, is that when you're thinking about how to construct investment strategies, it's it kind of goes back to the Jason Buck comment I made, trying to think about all the different outcomes that could happen, and then, sort of allocating or having exposure to the assets that might benefit in those types of environments. And that's something that we've actually been working with some clients on and talking through. And if you think of the last like 10 to 15 years, how dominant the S&P 500 has been, it's basically, if you've been a large cap growth investor, you've pretty much like had a Sharpe ratio of like whatever, zero 0.8 or 1 or something. It's like the best performing strategy out there. That's changed slightly in the last couple of years, but kind of not when you look at the last 10 to 15 years with the S&P. But there will be environments where, international stocks do better. We're maybe in a period where commodities can start to do better, and they have been doing better. These other asset classes that haven't been doing as well, thinking about how to get exposure to some extent to those types of asset classes. So you're kind of creating a portfolio that can do hopefully well or decent in all different types of market environments, given that we can't predict the future.
I'm always fascinated by, I feel like it's the people I most respect the older they get, how they say the older I get, the less I know. And they don't mean like I got dumber. They just mean making peace with that idea that more things can happen than will happen. So whatever you think will happen, that's that one path. That's the one strand of spaghetti out of the big old bowl of spaghetti that ended up happening. Yeah, like that belongs on my wall probably. More things can happen than will happen. If I thought of that first thing every day, life would probably be better.
Yeah, for me, Jim O'Shaughnessy is a great example of that. Like, he always talks about how, like, he's really recognized what he doesn't know. And, he, in our space, at least, Jim O'Shaughnessy is like, at the top of the podium or whatever. He's as good as anybody. And so, like, if he can recognize what he doesn't know, like, I need to recognize what he doesn't know, what I don't know. And Justin, by the way, since we got another live podcast coming up here the week after next, we're going to be on Value After Hours. So you might expect to receiving an email from me in about a week about my plans that have come up, so we can get myself a little revenge there.
Well, I'm okay with Toby and Jake, but
yeah, me too. I'm actually really
hopefully you don't bail on me.
That one will be a lot of fun. I'm actually looking forward to do that one. So yeah, to close it, I think we'll play both these clips simultaneously because they both kind of get at the same thing. But it's Daniel Crosby and Mike Green both talking about kind of putting all of this in the context of what matters.
Put first things first, right? We spend all this time talking about money, but money is only as good as the life it builds and the people it serves. And so I think in your pursuit of money, right, in your pursuit of acquisition, make sure that none of it's happening at the expense of the people that you love the most. I think it just becomes really easy to let family and relationships take a back burner when you're trying to get ahead. It's easy to tell yourself that you'll be around when, or you'll do this when, and I just think that none of this should come at the expense of your health. None of this should come at the expense of your family. And I think that people who put first things first are going to be all right over time.
Oh, just remember the portfolio is secondary to your life. Like that I honestly think we often really lose perspective around that. And I just continually emphasize, it's part of why you hear me railing against the behavior of the Federal Reserve, et cetera. We behave as if everything is about financial outcomes, as if the market tells us truth. There is no truth to be found in financial markets. There is no truth to be found in financial assets. There is no truth to be found in your relative success in terms of your wealth or anything else. The truth is to be found in the smile of your child, the greeting that your wife gives you when you come home, et cetera. Enjoy life and try to be a better person every single day in that context.
So yeah, this one kind of hit home for me because, I tend to, like, as a factor investor, I tend to get into like, let's take, find the 14th factor that best optimizes my portfolio. And I tend to do all these things that sort of are focused on like, the weeds of what's going on. And like, it's so important to take a step back and say, like, why are we even doing this? Like, why are we doing it for ourselves, our families, our clients? Like, what are we doing it for? It's like when you put it in that context, like, it's about your family, it's about your life, it's about things like that. It's about the purpose of the money and what it does for you. And like, nobody's going to be excited about being buried with, a 401k statement that has, $10 million and like putting it on them in their casket. Like, we all have to take a step back and realize why this stuff matters and why it's important. And so I thought both Mike and Daniel kind of got at that idea.
Yeah, I thought like Mike's point, like, there's no truth in financial assets. Like when you actually, but where is there truth? There's truth in the smile your kid gives you when you come home, or maybe the hug that your wife gives you, before you go to bed, or whatever that is. Like, it kind of really like hit me because when you think about like financial assets, like it's just millions of people buying stocks or bonds or whatever they're buying. And like, yes, those are like assets and those are giving you some return, but everyone has different opinions about all those different things. So, and some of those are right, some of those are wrong, some of those are greed, some of those are fear. And so there isn't truth in that, but there is truth in like the relationships that you have, the people that love you, the people you love, the things you care about. And so I think, thinking about it, Mike's just such a deep thinker, and he's been great. He's come on a couple of times with us. And these guys that are thinking like levels above where we spend day to day, I think it's important to like really think about what they're saying, because it can help you, at least for me, it helps me sort of come above the fold, or try to at least, and think about like what's important in life. So I think that's a great one, Jack, for sure.
It's also making me think that for every CMT out there who's screaming price is truth all the time, we need to take another, we'll bring it back to Ted Lasso, football is life from Danny Rojas approach. There's more to this. I think about this too, and I see this, especially when we talk about and connect it back to markets and parts of what we do for a living, is this idea of transactional versus relational approaches and how those compound. Like a transactional thing, like I could rip you guys off once, maybe twice, maybe 3 times or something. And like, that's a transaction. I can profit off the transaction, but that doesn't really compound or go anywhere positive for anybody long-term. A relational approach where like us starting this offshoot of the podcast together, like we take a shot. It's an investment of our time and effort, but we all know we like spending time together and talking about this stuff. So this relational approach, like it brings value to my life. I hope it brings value to yours. I know it brings value to some of the people who are listening in, and that stuff compounds too. And the more we take that relational zoomed out, like how does this build value in my life and others and the people I care about, what Ben Hunt calls his pack, the people who want nothing transactional from you, but just want that relational value to compound. That's the most beautiful thing. And I think that's where, like Mike Green, like Daniel Crosby says, like that's where our focus really needs to be. That's a happy life.
Yeah, like just to bookend it, like the quote from Daniel and his was, in your pursuit of acquisition, make sure that none of it's happening at the expense of the people you love the most. And it also reminded me of, there was this thing Sahil Bloom put on Twitter the other day, and it was something along the lines of, the only people that are to remember how late you worked are your kids. And obviously what he's getting at is not in a good way. So like, it's just important, like not just with investing, but in life, to kind of put everything we're doing in context and take a step back and remember what really matters.
So that's a good way to end it. We hope you guys enjoyed this episode. We're going to try to do more of this, where we kind of take pieces from our other podcasts and sort of talk to these points and try to flesh them out a little bit more. So thank you guys for listening, if you've made it this far, and we'll see you next time. Hi guys, this is Justin again.
Thanks so much for tuning into this episode.
You can follow Jack on Twitter at @PracticalQuant.
You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at CultishCreative.
If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment.
Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.